If we are looking at saving on interest, okay, what you would save in interest for new homes at Penrose against Sims Urban Oasis, you would have actually saved about 78,000 here. Okay. And if you were to look at Trevor versus Points, okay, because Trevor is a new home and the Points is subsale, you would have saved about 97,000. Are you really looking at saving on interest, that means buying new homes? Or is it really looking at rental income that could supplement you the additional close to 200,000 income for 4 years, right? Okay, and more often than not, most of you would likely be thinking about this right now. Okay, saving on interest, buying new homes, or getting rental income to give you net margin. Okay, so is it really about these two things? So what I'll share you here is that looking at the three different comparisons just now, if we are looking at saving on interest, okay, what you would save in interest for new homes at Penrose against Sims Urban Oasis, you would have actually saved about 78,000 here. Okay, and if you were to look at Trevor versus Points, okay, because Trevor is a new home and the Points is subsale, you would have saved about 97,000. Okay, and why is the gap bigger? Because the Points, it's basically a lot more expensive, so to speak. All right, and of course, resale against resale, that means both are already at full disbursement. Your gap is not a lot. You just differentiate in terms of buy price. That's all. Okay, but what you want to look at is the cap gain and real gain. So for new versus resale, Penrose and Sims Urban Oasis, we see that cap gain is actually Penrose that make about 500,000 based on gross numbers. But in real numbers, it's actually the Sims Urban Oasis, which is resale, because of the 4 years of there's a backlog of construction delay, and we see rental prices shoot up tremendously. So the difference, even though we are looking at 22.8 against 25.6, the difference is just $10,000 difference. So what I'm trying to share here is that if you get your segment right, even though there's rental income, okay, it's not going to be too far off from what you are getting. Okay, so you still are pretty good to go. So when you look at new versus subsale, okay, which is Trevor against Points Residences, the gross gain is 16.1% for Trevor and also 7.4% in real gains. That means new actually does better in both cap gains and real gain. And in resale versus subsale, Coco Palm actually did 8.5% in capital appreciation in terms of gross appreciation, but in real gains also does better at 5.9%. So right now, new homes versus resale, resale win here. New homes versus subsale, new homes win here. And resale versus subsale, subsale win here. And right now you must be thinking, yes, resale also can buy, new homes also can buy, subsale also can buy. Then which segment to buy, right? Okay, so our team literally went through, back and forth, cracking our heads and everything, and then we realized that the real denominator here is really your price gap. Okay, because you learned just now that based on the 2023 and 2024 price gap, new homes versus resale gap, it's supposedly to be close to high 20%, but right now it's only 8.5%. And for new homes versus subsale as well, it's also mid 20% thereabouts. And right now it's only 3.5%. And so resale versus subsale also that you learned just now is almost around, low 20%, given what has TOP in just 2024 this year. Okay, so the price gap segmentation of knowing which is undervalued based on these gaps will really allow you to see which segment you need to buy. That's why I can't stress enough how this price gap is so important, so that you then go in the right segment for the right reason. Okay, right. So that's it. We're gonna go into something a lot more exciting here, and it's about learning from the past and how can we really pivot from here. So learning from the past, we know that interest rates have been high over the last couple of years and may continue to hold. All right. In fact, the Fed says that they want to cut rates 6 times, and that has not been really happening. And also, rental prices has been high over the last couple of years, and that is before overcoming a backlog of construction delay. So right now it will be, of course, going down. So price gets spiraling over the last few years, mostly driven by pandemic and multiple en-bloc activities over the last 6 to 7 years, right? Or rather 6 to 8 years. And of course, market is expecting an oversupply, and developers are very cautious about participating in land bids too. So understanding the market right now is like that, then how are you going to pivot from here? Right? So many things happening in the marketplace. So I want to share with you that beyond all this noise that you hear, okay, what's so important here is what's the best for you and when. And that's where we talk about the right fit at the right time. And it's about you, okay? So in this case, can I ask, how many of you has attended my previous masterclass back in January, okay? And we talk about this thing called which profile are you, we basically brought out or categorized 4 different profiles back then, called profile ABCD. Okay, so if you have attended the previous masterclass, I would like you to just type me inside the chat so that I know that you have heard about this before. This is not the first time that you are seeing this. Okay, so how many of you has attended the previous masterclass before? Okay, so Susan says that I saw your video on YouTube is insightful. Sean says me. Okay, so anybody else that have seen it? If you have not, you can just reply no inside the chat so I also know that you have not seen it. Okay, right. So those that have not seen it, for the benefit of doubt, I'm going to play this video one more time. Okay, I see most of you have not. And I'm going to let you understand this profiling. And this profiling is very important because as you are looking at this video, I want you to categorize yourself under different profile ABCD. Okay, so after this video, I would like you to, of course, type that profile that you think you best resonate with inside the chat box. All right, okay, so I see a lot of no here. Okay, so I'm going to play it right now. Let's go into the types of buyers. Profile A. Profile A, fast in and out, financially capable, at least 1.7 million. Okay, so when we talk about that, we mean that at least in the new home segment, used to be, as you learned from the past, 3-4 years to buy new homes, you're going to make money, right? And in today's context, you're going to go into any 2-bedder, minimum around 1.7 million you need to have. If not, you're probably treading along the line of a 1-bedroom or 1+ study. Okay, and this is difficult because when you buy a 1-bedroom or 1+ study, the kind of buyer that you sell to next time, okay, are either bachelors, investors, or even retirees, right? Okay, and these 3 groups of people, more often than not, especially the investors, they look at the yield, so they probably won't pay you the profit that you're after. So it's very important that, you know, we want to minimum get a 2-bedder for safety context. Okay, so it is for non-leasing. That means you do not want to deal with the nitty-gritty. You just want to basically buy in 3-4 years later, TOP yourself. Okay, and the intention is quite clear. You want capital appreciation, and you want to use progressive payment to basically subsidize your interest rate. Okay, because the interests are being paid progressively, and you want in and out, quick, fast. Okay, so this is profile A. But typically for this kind of investor, your buying power in terms of your budget must be stronger. That's why we use 1.7 million. Okay, and profile B, they are mainly driven by cash flow. That means you want passive income, but at the same time you want high margin for your profit. Okay, you want capital gain and you also want rental income. Basically, you will do everything to achieve the maximum to optimize. Okay, I believe profile B will be some of you out there, they are looking for some form of, you know, safety net. No income, not working, at least got rental coming in, etc. Okay, so those people fall under this category. And more often than not, you buy something that is already ready, right? Okay, so that's the resale so-called segment. And profile C, someone that wants to utilize today, likely profile with family and children, and the intention is to upgrade as soon as possible or to even decouple, depending on their couple. As a husband and wife, do they earn more together? Okay, and also the time horizon is also sensitive based on the children's needs and whatnot. Okay, and then profile D will be dwelling but wants renter, stay and still want renter, and likely we're going to go into UT zone of new township and relocation of, you know, as I said, why that? Because this is likely their last move and they are using it for legacy and rental. So like I said, this is for someone that are a lot more older